All right, everybody, thank you so much for coming on to the call today. Very happy to have Guy Kaufman as our guest speaker. Guy is going to be talking about startup equity, what you need to know in the UK, especially relevant for a number of people who are from different countries. And even UK entrepreneurs can get some of this stuff wrong. It's not easy. Generally, you have to pay lawyers lots of money to get this right. And what startup has lots of money to pay lawyers at the beginning? Not many. All right, just we want to share a couple of things before we kick off. My name is James Schumark, if you didn't know that. At 5 to 5, round about then, we're going to announce our vested discount codes. And this means that you can get access to Launch for free, or you can get a 50% discount off Launch Plus. And Guy will maybe talk about them in a bit more detail.
Thanks very much for the introduction. So, as James said, I lead the launch project at Vested, and basically spend my time talking to founders and entrepreneurs really about equity and investment and this thing called the ownership effect, which basically is the idea that sharing equity with your wider team can be a positive thing. You know, it can change their relationship with the company, with the project that you're building emotionally and psychologically, and ultimately it leads to more growth. It's not necessarily going to mean that people, miss their daughter's play or do anything crazy like that, but it might change some of the percentage decisions here and there. And get them more invested, I guess, in your company and what they do. So that really is the premise upon which Vested was founded, and we exist to make sharing equity easier. Been around for about 5 or 6 years now, and really help startups and SMEs set up share schemes for their company. What I do is more focused on very early stage businesses. So it is helping people like you set up your company in the right way, avoid some of the, the bear traps that people encounter. And hopefully today we'll cover some of those things. I am aware it's not necessarily the sexiest topic in the world, but it is really important. Equity is kind of the tool by which, hopefully you'll all become millionaires, and the tool by which you'll influence all of the decisions that are made in your company. So it's really important to get it right. Today, really, we'll be focusing on the fundamentals. Apologies if some of this stuff is quite basic, but I figure it's best just to start right at the beginning from what shares are, different types of shares, and we'll work our way through it. I will try and pause at different parts, different moments, to give people an opportunity to ask any questions. Otherwise, feel free to type them into the chat and we can deal with them as we go. But like I say, I'll start at the beginning, which is equity fundamentals. So the very first slide, like I say, is on what are shares. Now, every limited company in the UK is split into a certain number of shares, as decided by the directors on the incorporation of that entity. And it's a bit naff, but I tend to describe it or envisage it as a pie split into many equal slices. The shares and the details of their holders are kept by the company in a share register. That's a legal requirement, and that's often referred to as a cap table. So if you use a tool like Vested Launch, like I say, we're offering this to free to you guys. You can manage that really easily. And it's something that if you do go for investment rounds, for example, I know a lot of you will be thinking about that. Any prospective investor will want to see that. They'll want to understand exactly who owns what and what their rights are. Now, the shares or the different slices that we're talking about all have certain rights. Those can be rights to dividends, they can be rights to capital, or they can be rights to vote, and they can vary in different ways, but they're laid out in a company's articles of association. And the articles of association are publicly available, so anyone can view your articles. They're essentially the rule book that govern how a company is run, and they're all held at Companies House. When you incorporate a company and you split it into all of these different slices, you'll also be required to put a certain amount of capital in. There's no minimum amount. More often than not, we see companies being incorporated with maybe £1 or £100, but the nominal value of a share, and this is a phrase that you'll see used very often, is simply that initial capital divided by the total number of shares. So if you put £1 into the company and you have 100 shares, then the nominal value of each share is a penny. It sounds really obvious, but the nominal share stays constant, the nominal price rather. So you will see the share price referred to, and you'll hear the nominal value referred to, and those things are often different. You know, as time progresses, your company starts to hold value, you know, you start generating revenue or you attract investment, essentially a premium is going to be placed on that nominal value, and that reflects the increase of value of the company. So it's important to get those two things right and to distinguish between them. A lot of people will ask, you know, what's the right number of shares to incorporate a company with? How many shares should I have? There's no right answer to that. In truth, like I say, you'll often see companies incorporated with just a single share or 100 shares, perhaps. I tend to suggest that a larger number can be more useful. It allows for a greater level of flexibility. Of course, you can only give one share away to people at a time, and you don't necessarily want to be giving, you know, a percent, for example, to each person you're enfranchising in this business. So it may be more useful to have a larger capital structure, for instance, 1 million shares. And that means you can still include people in the project. You can still allow people to experience some of that ownership effect, but you can give them much smaller amounts. So, for example, if you use the vested incorporation tool on Launch Plus, our guided flow brings you up to a total of 1 million shares. That's just our sort of guided route towards it. Are there any questions on that, or should we jump into the different types of shares?
Perhaps you could just touch on why it's not a good idea to give a percentage, or to talk about a percentage, Guy.
Yeah, absolutely.
Later.
This is something that comes up time and time again, and particularly when I'm dealing with people or helping people who perhaps haven't done this before. You or I, everybody thinks in percentage terms. You know, you talk about giving someone 10%. That's what we always see discussed in, you know, Dragon's Den or Shark Tank. And although it's right to think in those terms, it is better to express it, particularly if you are putting pen to paper and actually agreeing things with people, in terms of a number of shares. And that's because as your company grows, and for example, you raise investment, you will typically issue new shares in order to raise that investment. Now, you as a shareholder, as an owner of ordinary shares, will get diluted as you issue new shares. However, if you've promised, let's say 5% or 10% to a freelancer or an advisor who's helped you, they will stay having that fixed percentage no matter how many new shares get issued. Whereas, you're going to get diluted with each new round of investment that comes. So your total shareholding may well decrease to something relatively insignificant, whereas this person who maybe did a relatively small job for you right at the beginning of your journey is going to stick with this potentially large percentage of your company. So it's really important to talk about the number of shares when you speak to employees or advisors, consultants, anyone who you might include in a scheme or who you might want to reward with sweat equity. Does anyone else have questions on any of that?
So there is a question in the chat. Maybe I should just read it out from Slava. If a founder will issue new amount of shares, in brackets, it's also interesting how to do that in bracket, how price will change common and preferred shares?
Right. So when you issue new shares, first let's talk about the process of doing it. It's a relatively simple process. You need to file an SHO1 form at Companies House. If you use a platform like Vested, so Vested Launch, for example, you can do that completely for free because it is fully integrated with Companies House. So when you do something on the platform, it's reflected at Companies House and vice versa. How does that impact the value of the shares? Well, in terms of your percentage ownership will decrease because, if I have 50 shares and James has 50 shares and we issue Bob another 50 shares, then, the number of shares that we own stays the same, but clearly as a percentage or a fraction of the pie, instead of owning 50% each, we now own 1/3 each. The value of the company hasn't necessarily changed. However, typically when you issue new shares, it's going to be for a purpose that you would expect would increase the value. So either it's going to be for the purpose of raising investment, you're issuing new shares to an investor who's putting capital into the company, and that capital will be spent on, marketing or product engineering, hiring new sales folk, and those different actions should increase the value of the company. Or you're issuing new shares in order to enfranchise members of your team. This is the ownership effect that I touched on earlier. So, there are a huge number of studies out there that show giving, employees or members of your team a slice of the pie makes them work harder, in essence. And again, issuing new shares might decrease your percentage of the pie. However, in theory, it's a smaller piece of a bigger pie. So, your value should increase. That's certainly the idea and the theory behind it all. Is there anyone else there? If not, I'll move on to different types of shares then.
Oh, hold on. Alexander did actually put a question in the chat.
Oh, sorry. I think my technical prowess means that I'm now just on my slideshow, so can't see stuff popping up. Sorry about that.
No worries. So Alexander asks, what is your opinion about option agreement with key persons where number of shares depend on results in terms of work? How option agreement have to be registered?
Yeah, absolutely. So I do have a section of this presentation all on options. So I might hold that question for later.
I think also you're gonna next week, the next event, you're going to be talking about that as well, aren't you?
Yeah, that's right. So look, I'll talk to you a little bit about it later this afternoon through the course of this, because I think it's an important thing to understand. And what I will say now is that option agreements are fundamentally different to giving somebody shares.
Okay, one last question before we move on then. Somebody, Andre has asked, is it possible or reasonable to set up shares with different nominals for a startup?
It is possible. Absolutely. It's typically not advised because it makes some of the calculations later down the line about percentage ownerships much more complicated. So it would be unusual. And if I was setting up a company now, I would try to avoid having different nominal values for different share classes.
Okay, great. Well, we'll just move on to the next part then. Thanks.
Yeah, and thanks for the questions, guys. I think if you've got anything, do type it into the chat or shout out. So different types of shares. You'll have heard of ordinary shares, I'm sure, and you may have heard of pref shares. Growth shares are slightly more unusual. However, we do see them used by customers at vested a lot, both for reasons of tax efficiency and conditionality, as I'll go into. First of all, though, let's touch on pref shares because it's relatively straightforward. I mentioned earlier in the presentation that share classes can have rights to capital, rights to vote, and rights to dividends. And in essence, a share class can have any combination of these rights. When you go to try and raise capital, when you go to your angels or VCs, you may well find that under the terms of investment, they want shares with preferential rights to any of these three things. So they might want preferential rights to voting, for example. Certain investors might want veto rights, or they might be must-sign investors on certain types of resolutions. That's quite common. Similarly, they might have preferential rights to capital. You know, if there's a liquidation of the company or there's a winding up of the company, they might want to get their money out first before anybody else. These things are all pretty common, actually, when you're dealing with VCs and angels. What I would say is don't be scared by it. Also understand your own negotiation position when you enter these, because it is a negotiation, and you don't necessarily have to, you don't necessarily have to give people what they ask as soon as they ask for it. So you may be able to negotiate these things slightly. Lots of people will only ever deal with ordinary shares. They will only ever issue ordinary shares in the company, and that's also absolutely fine. So ordinary shares, in essence, have pari passu rights to capital, dividends, and vote. Basically, they all have equal rights to these things. As a sort of warning about how they work, the two things that we talk about a lot at Vested when we're discussing share schemes are conditionality and tax. When you issue ordinary shares, if the company holds value, then the shares hold value. And if, for example, you decide to, you want me to consult on your business, but rather than paying me in cash, you're going to pay me in shares in your business, the government, HMRC rather, will see it as a benefit in kind. And the recipient of those shares will incur an income tax. If the shares were worth £100 cumulatively, for example, I would face my marginal rate income tax bill, let's say 40 or 45% on the value of those shares. So I'd end up paying 40 or 45 pounds on them. That can be a problem for all sorts of reasons. For example, startups are high risk. The value of shares can go down as well as up. So lots of advisors who you might be paying in sweat equity may not want to, to incur that tax liability, at a point which is often far, far before they'll ever be able to crystallize or realize any gain. The other sort of potential problem with them is that there's no conditionality to them, which touches on the question about options earlier. So when you issue ordinary shares, it can be very difficult to claw them back from people if they don't do what they say they're going to do. There are no vesting conditions attached to them. And the answer, generally speaking, is to either grant people options or to issue them conditional shares, shares with vesting conditions attached to them. And that's why I thought I'd talk a little bit about growth shares today, because growth shares are, in essence, a separate class of shares that have limited rights to capital. The way that they're enabled through the vested platform, through Launch Plus, is that they're also made conditional, which can be extremely useful when you're setting up frameworks for sharing equity between co-founders or advisors or anyone else. But first of all, I'll just talk about their rights to capital. So in the case of growth shares, they have a right to future capital. In essence, you'll look at what the value of the shares are today. Let's say they're worth, what's this, £3. You'll set a hurdle rate at the value today, maybe slightly above it. So at, let's say, £3.20. And then the owner of these growth shares participates in all of the value created beyond that hurdle rate. What it means from a tax perspective is that when they're issued, they don't hold any value because they only have a share in future value. So there is no income tax on growth shares, even if the company is a valuable company. It also means that it limits the impact of shareholder dilution on existing shareholders, and so can be very useful from a tax and from a shareholder dilution perspective. The third point was that they are conditional, and this is really, really useful for early stage founders, even if the company doesn't hold any value, because you can issue them to people with conditions attached to them, you know, things like KPIs like revenue targets or company valuations, such that if they meet those targets, the conditional shares are transferred into unconditional shares or converted into unconditional shares. And if they fail to meet those conditions, they're deferred. And when you defer a share, you strip it of all of its rights. So it loses its rights to capital, its rights to vote, and its rights to dividends. Essentially, it's now worthless. And so what you end up with is this, to my mind at least, much neater mechanism for holding people to account and ensuring that, you know, whatever happens, if people don't hold up their end of the bargain, they don't profit from, you know, your endeavor, which is an issue which, to be honest, you see all too often in the world of startups, and can often lead to disputes between co-founders, as you might imagine, which is the number one reason for startups failing, actually, are co-founder disputes. So it's something that's worth thinking about. They're a tool that are facilitated through Launch Plus, and using that tool, you can create frameworks to essentially, I call them founder prenups, right? You're saying, we've all agreed these different outputs. If we, you know, hit those outputs, then great, we get to keep our shares. If we don't, then they're deferred, and sorry, you haven't done what you said you were going to do. That's a slightly more complicated subject and something I plan to cover in more detail in a future session. But as is often the case, I found myself being diverted into it. Are there any questions on any of the things I've just touched on? And James, would you mind reading them out from the chat?
Sure. Well, we don't see anything in the chat at the moment. I think this is very interesting. I've never heard of growth shares before. And is this something that lawyers keep secret, or is it something that you guys have created?
It is, no, absolutely. They are a very established class of shares. Typically, if you were to ask, you know, go to your solicitors and ask them to draft, beg your pardon, growth shares for you, it would cost a fortune because they're quite complicated to construct. You know, the model that Vested uses is we've already, it's a sunk cost for us, right? We've already had them constructed. So if a customer of ours wants to use growth shares, so if a Launch Plus customer wants to use them, or somebody wants to incorporate with us, they adopt a set of articles of association that we've already drafted. Those articles are based on the British Venture Capital Association's model template articles. So they include lots of clauses that are useful for a company's growth trajectory, but they also include these growth share clauses, which are really useful as your company grows from a tax perspective, and are really useful because they're conditional, and conditional shares can be difficult to draft otherwise.
Okay. So Sasha has asked if you could give an example of offering shares to co-founders. I know that you touched on it earlier, but maybe you could give a more another example. Maybe
in terms of the types of conditions that you might offer, or what do you mean? Sorry.
Do you have any stories of where it's gone wrong? Horror stories?
Yes, I mean, it's sort of all too frequent. And to be honest with you, it's the cliche things that you might imagine. Sometimes it's just the person that you go into business with isn't as hardworking as you imagined, or isn't as up to the task as you imagined. Other times it's something that's completely fair. You know, I meet the love of my life and follow her to Costa Rica, or I get offered my dream job at, you know, Google, and I can't say no to it. Or there's a whole range of reasons why people might not follow through on, you know, their promise to you, and can't complete the things that you wanted them to complete. But if you just give them ordinary shares, those ordinary shares are really difficult to claw back. I'm not saying it's impossible, but usually it would necessitate expensive lawyers' fees, right? You know, in order to claw them back, that's what you'd need to do. And that's something that we've seen at Vested time and time again. The beauty and the reason for setting out these agreements, these founder prenups, if you like, is just that everyone knows what's expected of them. If people don't do anything, there can be no argument, because you've said, you know, Guy, you've promised me you're going to use your high net worth contacts to raise us £1 million. Well, you've not raised this diddly squat, so why should you have, you know, a third of this company? The answer is I shouldn't. And if you think about those things at the outset, if you have those hard conversations, and the reality is they are hard conversations with your co-founders, with your team, then in my opinion, you'll save yourself a whole world of trouble and strife and, you know, tears and everything else down the line.
So I know that very often people can look at the American model and think they just issue shares over a period of time, like over 4 years with a cliff. But of course, that doesn't work here in the UK, does it?
Yeah, it's different. You know, you see different models for founder vesting. What I'd say is this is tried and tested. Oftentimes, there's all sorts of different models for doing it, right? So you might say that shares vest over time, and if somebody leaves, they will, for example, transfer shares to another shareholder, or there'll be a company buyback of unvested shares. These are all things that I actually see quite commonly. The problem is, if, for example, you are going to transfer the shares to one of the other co-founders, that would create a tax liability for the other co-founder, because if the company holds value, you're transferring him something of value. So once again, there's going to be an income tax bill. Likewise, if you set up a founder vesting using company buybacks, there are really strict rules that govern company buybacks. Generally speaking, they have to be done either out of retained profits, so you have to be a profitable company, or they can be done under what's called the de minimis exception. Now I'm really getting into quite complicated company law, but the de minimis exception means, I probably need to fact check this with our in-house counsel, but in essence, shares can only be bought back up to a maximum of the lesser of £15,000 or 5% of your aggregate nominal value, which won't be very much. You know, if you're talking about a co-founder who has 30% or 20% or, you know, over 5%, then it becomes very, very difficult. Our system, you know, using growth shares and using deferred shares, alleviates those problems.
So somebody's asked, does it mean that founders have only growth shares, or can they have both ordinary and growth shares?
Yeah, good question. Typically they'll have both, actually. Yeah, it's a philosophical question as much as anything else. It depends on how you guys want to set it up. Very often what you'll see, for instance, in an incorporation tool with vested, is you might have a layer of ordinary shares. So using the example earlier, James, myself, and Mike go into business. Maybe we're going to have 333,000 ordinary shares each. We're going to have a cap table of a total of 1 million ordinary shares. But on top of that, you might decide to issue growth shares that are conditional. So, James is going to bring his extensive network and contribute in that way. I'm going to bring my sort of knowledge of equity management and so forth. So you can absolutely have a combination, and that can be a sensible way of doing it.
Okay, one final question before we move on. Julia's asked, are ordinary and growth shares the only type of shares?
No, absolutely not. So pref shares, I already mentioned. There are lots of types of shares is the answer, but the most common that you're going to see are ordinary shares and pref shares and maybe growth shares. Most companies, many companies, will only ever issue and use ordinary shares. But if you go for investment, most investors will want, lots of investors will want preferential rights, and that's when you'll encounter pref shares. And if you want to, I would say, be a bit more sophisticated about the way that you structure a business, you may well decide to use conditional shares, conditional growth shares. I wouldn't say it's necessarily the norm amongst all the, how many startups launch a year, James? Thousands and thousands in the UK, but it is increasingly common, particularly amongst, the companies that I deal with, which are typically on a high growth trajectory. They're typically made up of a founder team to make use of these different share classes in order to create a more tax efficient structure and protect themselves from the realities of the world, which is different opportunities arise for different people, and they won't always be able to continue with the projects you've started together. I hope that answers that question. We will be going into it in more detail on all of this stuff next week. I thought I'd do a bit of a high level session today. So if there is more, feel free to ask again at the end, or indeed we'll pick it up next week. Somewhat conscious of time, I will leap into talking about option agreements, because I know there's already been questions on these. Instead of issuing shares, you can award options. And now options are fundamentally different. When you issue somebody shares, they immediately have certain rights as a shareholder, as I mentioned earlier, and they appear on your cap table for everyone to see, because these are publicly available records at Companies House. What you may well want to do instead is to grant somebody, whether they are an employee or a co-founder or an advisor, whoever it might be, an option to buy shares at a pre-agreed price in the future. It's a common structure in, there are all sorts of option products, financial products, and different types of, whether it's equities, bond market, whatever it is. In this context, we're talking about buying shares in your company, in your private limited company, for a fixed price at a point in the future. And what's particularly interesting and useful about them is once again that they're conditional. So if you don't want to issue people shares, you don't want them to be a shareholder from day one, you may well decide to grant them options. If you don't want to, for example, adopt the vested articles of association in order to use those growth shares, you might decide to grant them options. And these are an incredibly flexible and useful tool. And in fact, it's probably the bread and butter of what Vested as a company does. We are a share scheme platform with a preeminent share scheme platform in the UK. And one of the useful parts about them are that you make them conditional. So option agreements will have vesting conditions, meaning that they can be exercised in accordance or once these conditions have been hit. Now, I would broadly speaking divide this into two routes, time-based or performance-based milestones. For an early stage company, so the businesses that you're dealing with, time-based vesting often makes sense. The reason I say that is often companies come to me with a view to setting up quite complicated vesting conditions. It might be a revenue target, for example. Absolutely facilitate something like that through Vested. It's very, very common. However, if you're in your first 6 months of operation, or if you're in your first year of operation, a revenue target for one of your sales guys or girls is going to be drastically different to the revenue target that might apply in year 2 or year 3. On the other hand, if that individual is still working for you in a year, 2 years, 3 years, 4 years, generally speaking, I'd say that you're likely to be happy with their performance. So oftentimes for early stage startups, time-based vesting works particularly well, but you can do a combination of these approaches very easily. The other thing that I'd say about options is that they're not all equal. So in the UK, there are different types of tax-advantaged option schemes, the most famous of which is an EMI option scheme. So that's an enterprise management incentive. I am going to go into all of this in more detail next week, but the long and the short of it is, if you price an EMI option in a certain way, essentially you have to set the exercise price at least the market value when you grant the option. The recipient of that option will face no income tax, and the company, so you, can offset any gain that a recipient makes against your corporation tax. If we use an example, let's say today your company is worth £1 a share. So you set your exercise price at £1. The recipient will face no income tax bill on that. And when they sell the shares, let's say they sell the shares at a £10 value, all they'll face is a 10% capital gains tax rather than the usual 20%, meaning that all the tax that they pay is just 90p. So they're going to walk away with £8.10. And as a company, you're going to offset all of the gains, so £9 against corporation tax. With an unapproved option, it works exactly the same. So it's a right to buy shares at a fixed price in the future. You attach your vesting conditions. However, there's no tax wrapper on it, meaning that the recipient of these options, or the owner of these options and the eventual owner of the shares, will face an income tax bill on the value of the option. If you think about it, the value of the option is the difference between the exercise price, so the price that they pay for the shares, and the eventual the eventual exit price. So in this example, the exercise price is £1. The market value when they exercise is £10, so the gain is £9. So they're going to pay their marginal rate of tax on that full £9 gain. In other words, they're going to end up with £4.95 instead of £8.10. I've gone over this enormously quickly because it's quite a complicated topic, but what I'm trying to say is that there are some really attractive tax advantage option schemes available. There are strict eligibility rules that govern them, but once you're up and running as a company, if you're trying to enfranchise your employees, you're trying to experience some of that ownership effect, then it's worth looking into which tax advantage scheme you might be eligible for. And in particular, I'd highlight the enterprise management incentive, the EMI option scheme. Like I said, I've covered that really quickly, but welcome any questions that you guys might have.
I guess the one of the reasons why it's been hard for me to get this kind of information from lawyers is the tax element. I mean, lawyers are not accountants, are they? So you need to be a legal expert and a tax expert to make sense of this.
Yeah, and the other reality of this is that a lot of it is talked about in jargon and legal speak, rather than plain language. And one of the things at Vested we've tried really hard to do is produce content that hopefully is digestible and understandable by you guys, and speak in plain language. Now there are some terms that you can't avoid: exercise price, nominal value. There are some things that you just can't avoid, but there are other ways that you can express things that hopefully make it easier.
Okay, well, we're approaching time for the breakout rooms, but we've still got a few minutes. If anybody wants to either ask Guy their question, you can unmute yourself and ask the question, or you can put your hand up and I'll invite you to ask your question, or you can put it in the chat. I don't see any questions in the chat at the moment. I'm glad we've got a follow-up event for this one.
Well, look, there's a lot there to unravel. While I've got a moment, I will do a small plug, which is, as I said at the beginning, I head up our launch program, really and truly aimed at supporting people like you guys, early stage founders who maybe have some experience in this, but typically are going to struggle to make sense of the nuances of equity management. For that, we have two products. We have Launch, which is fully plugged into Companies House, allows you to issue shares, transfer shares, manage your cap table, all of that completely for free for a limited time for you guys. If you want to use the code, which I think James is going to share with you. Alternatively, you can incorporate a company, use the growth shares, use a intelligent framework to set out conditions for your co-founders on Launch Plus. Again, that's 50% off for a limited time. If you've got questions on any of it, my name's Guy, which should hopefully be fairly easy to remember. So, you find me on LinkedIn. I'm guy@vested.com, so I'm not hard to get to. I'm always happy to have a conversation with any founder who's looking at this stuff.
Okay, great. I did actually share my slides. I don't know if you guys were able to see them or not, but just to repeat, here is the discount to get access to Launch for free. Normally it's £25 a month plus VAT, and if you use Race 1 when you're signing up on Vested, you can, and it's vested.com, no E, well, only one E in Vested. And so you get 100% off for 12 months. And I think that is available until the 31st of December. Is that right, Guy?
Yes, or I think it might have been till the end of the startup race, right? Or shortly thereafter. So
yeah, the 24th of December then.
Yeah. But what I'd say is I'd encourage everyone to, it's a free resource for the time being. It's normally relatively expensive, and if you're looking at this stuff, it's worth getting your kind of your ducks in a row in your house in order, because it will make your life easier later down the road.
Yeah, I mean, for £50 a month, well, obviously there's VAT on that. You get 50% off, so it's like under 30 quid. And I think the advice, the tools that are giving people access to is just absolutely phenomenal. So thanks again. Okay.